Every trading strategy is built on this one concept. It doesn't matter if you trade SMC, ICT, trend lines, breakout, or simple price action. Every strategy is built on the same foundation. Now, before you disagree, we first need to agree on one thing, and that is every strategy acknowledges two market conditions: a trending market and a consolidating market. Again, whether you're an ICT trader, an SMC trader, or a price action trader, we all agree these two market conditions exist. But that's not the concept. There's something these two market conditions have in common, and once you see it, trading starts becoming much easier. By the way, if you want to take what you learned from these videos and trade with me, I have a free community where I share trade setups, live trading, and backtesting sessions. It's completely free, and I'll leave the link in the pinned comment. But first, let me show you exactly what this concept is. Let's start with a trending market. In an uptrend, price creates higher highs and higher lows. Now, we all know a higher high simply means buyers were strong enough to push price higher than before. Okay, and a higher low means sellers tried to push price down but failed to break below the previous swing low, and buyers stepped back in and continued the trend. As long as every higher low holds above the previous swing low, the uptrend remains healthy. Now, in a downtrend, we have price creating lower highs and lower lows. A lower high means buyers attempted to push price higher but couldn't break above the previous swing high. A lower low means sellers remained in control and continued pushing price lower. As long as every lower high stays below the previous one, the downtrend remains intact. Now, here is the secret concept. Notice that for a higher low to form, we need support. And for a higher high to form, we need resistance. Think about that for a second. Every higher low forms because support held. Every higher high creates a new resistance. Even in a downtrend, notice that every lower high is resistance. Every lower low creates support. Again, support and resistance. Notice a pattern? Now let's look at a consolidating market. Price creates a range high and a range low. You can see that price keeps failing to break above the range high. That is resistance. And price keeps failing to break below the range low. That is support. Once again, support and resistance. So think about what we've just discovered. In an uptrend, support and resistance. In a downtrend, support and resistance. In a consolidation, support and resistance. No matter what strategy you trade, no matter what market condition you're looking at, the market keeps respecting the exact same concept. Everything is support and resistance. Now, I know support and resistance might sound a little old-fashioned to some of you, because most traders are constantly searching for something more, should I say, complicated? You know, order blocks, fair value gaps, mitigation, the next fancy concept. And look, I'm not saying any of these concepts are useless, but strip away all the fancy names for a second. Just look at what price is actually doing, because at the end of the day, price is still reacting to support and resistance. That's all it's doing. Once you start seeing price simply moving from one support or resistance level to the next, that changes everything. Because if you know where support and resistance are forming, you can begin understanding where trades actually make sense, where your entries make sense, where your stop loss makes sense, and even where your take profit makes sense. Okay, I'm not a superhero, but I can probably read your mind. You're probably thinking, now that we know this one concept, how do we trade it? And fear not, I got you. Let's say we see market structure like this. By the way, this is gold on the 15-minute time frame. And using the knowledge we have, we need to read the structure with support and resistance in mind, not just higher highs and higher lows. Now, in an uptrend, we are more interested in where support is formed, because it is at support that price is pushed to the upside. So we place lines like these at each level of our support. Now, I don't know if this applies to fuel prices in your country, but what goes up must surely come down. Meaning, if price is creating an uptrend, there will be a point when we see a consolidation, and then a reversal to the downside. So, in this chart on gold, we have this uptrend. What we want is for price to consolidate like this, and then we mark the consolidation as support and resistance. Now that we have those in place, we need to see signs of a reversal. We need a sign that price will break below all these previous support levels and push to the downside. And that sign is a candle closure. We need a candle to break below this support level and close. It has to close. Once it closes, we take an entry to the downside. Now, write this down. No candle close, no entry. Now we have the close. Then our entry would be set like this for price to push to the downside and hit our take profit. Now, a quick tip when taking trades like this is to use the lines you marked here as a form of take profit and manage risk as price pushes down. Trades like this are called out in my free Telegram community. Once you join, you'll get access to the 100 Pips manual for free and access to live trading and backtesting sessions to help you become a better trader. The link is in the pinned comment. Would love to see you. Thanks for watching, and I'll see you in the next one.